So how does an investment banker get hired to advise on a buy or sell side transaction? The origin of an M&A deal can vary greatly. Bankers become trusted advisors to their clients by maintaining strong knowledge of their industry and having relationships with the key industry players, which allows them to source opportunities and propose strategic acquisitions. For example, a banker could schedule a meeting with their potential client and present a handful of acquisition ideas with strategic rationale, the banker's relationship with that target company, and potential valuation implications. A client may like what they hear and hire the banker to advise and carry out the deal. In other scenarios, the transaction may be planned and initiated by the company, who then brings in an investment bank to be the hired help to complete the transaction. So for example, a Fortune 500 company may place a call to a bulge bracket firm and say, hey guys, we've made an internal decision that we're going to sell our non-core business unit, and we'd like to hire you to lead that divestiture process. Now, deals can develop quickly, or they may be years in the making. Investment bankers may propose the same M&A idea for years in a row before the timing and valuation aligns with the strategy of the client. In other cases, a macroeconomic shock to the industry or an internal company development could spur M&A activity. You saw this in the wake of the 2009 Great Recession, where highly distressed companies ultimately determined their best course of action was to sell to a more financially stable acquirer. Normally, dialogue between buyers and sellers as a deal is originated and consummated is friendly. However, there is one notable exception. In certain public company transactions, you may see what is called a hostile takeover. This is when an activist investor pressures the company to enhance underperforming operations and ultimately makes a public offering for the shares of the company, even if the board or management may disagree. This type of deal can still be completed if the public company shareholders elect to tender their shares at the offered price.